My pleasure to welcome all of you to the Motilal Oswal Financial Services call for the third quarter and 9 months ending December 2018. Consolidated revenues in the third quarter for the group stood at 6.8 billion rupees, and for the 9-month period stood at 19.7 billion. Asset management business reported a 22% revenue growth. Wealth management business reported a 21% revenue growth, and the capital market business revenue growth was at 5%. Capital market share in revenues was at 45% during the current quarter. Notwithstanding the strong performance of capital markets business, the share of annuity revenue streams continue to rise and were at 55% of our overall revenues, led by strong growth in the asset management AUM on a year-on-year basis. Consolidated profit after tax is 399 million in third quarter due to higher provisioning and write-offs taken in Aspire. Consolidated profits excluding Aspire and the mark-to-market gains, lumpy gains on PE exits, were at 1.43 billion in the third quarter, up by 2% year-on-year, and at 3.7 billion for the 9-month period, up by 15% on a year-on-year basis. Half of this profit is contributed by the asset and wealth business, while 47% of the profits are contributed by the capital markets business. Consolidated net worth stood at 30 billion rupees. Gross borrowings were at 49 billion. Net borrowings were at 45 billion. Excluding Aspire, the gross borrowings were at 12 billion and net borrowings were at 10 billion rupees. It's less than the market value of our quoted investments of 14 billion. Overall gearing remains conservative at 1.7 times. Ex-Aspire, it is 0.4 times. And considering market value of quoted investments, we are effectively a net cash balance sheet. The board has declared an interim dividend of 4 rupees per share for a face value of 1 rupee per share. Besides financial performance, the last few quarters have been eventful in terms of success in brand building, advertising, and several other fronts. MOP IBF2 was awarded as the PE exit performance of the year 2017 at the IBCA Conclave 2018. Our wealth management business won the Best Boutique Wealth Manager India Award at the Asset AAA Award ceremony. Our asset management company won the Best Portfolio Management Service product at India Wealth Awards. Our real estate business won the Best Real Estate Product at India Wealth Awards 2018. MOFSL was awarded as the Best Broking Business of the Year at the Money Control Awards of 2018. These and several other awards are recognition of Motilal Oswal as a preferred consumer and employee brand in the financial services space. I'll now run you through specific performance details of each of our businesses, starting with the capital markets business. Our capital market business comprises of investment banking, institutional equities, and retail broking businesses. Revenues for this segment stood at 8 billion rupees in 9 months and accounted for 45% of raised revenues. Profits were at 1.4 billion rupees, contributed to 47% of the 9-month profits of the group. Broking and distribution business profits grew by 32% year-on-year in the 9-month period, led by strong EBITDA margin expansion on account of better operating leverage, led by higher and linear revenues. In retail broking and distribution, our market share in the high-yield cash segment has been maintained on a sequential basis. Our overall market share stands at 1.7% in Q3 despite higher F&O volumes. Our strategy to bring in linearity in this business through trail-based distribution revenues is showing results. Our distribution AUM was about 90 billion as of December, up by 20% year-on-year. Net sales were at 15 billion in the 9-month period. With only 11.5% of the near million retail client base tapped, distribution income is already 16% of the retail broking gross revenues. We expect a meaningful increase in AUM and fee income as number of clients to whom we've cross-sold and the number of products per client cross-sold continues to rise going forward. In the institutional broking business, rankings with existing clients improved. Domestic institutions' contribution improved. New client additions were encouraging. And every aspect of the business continues to be strengthened. Tailwinds for local firms, in our view, remain quite strong. Investment banking business has continued to win some additional mandates. We have completed 5 ECM transactions in the 9-month period. Performance during the 9-month period has been impacted by overall market conditions, although our transaction pipeline remains encouraging. Turning to the asset and the wealth businesses, the asset management business across mutual fund, PMS, AIF reached the 374 billion mark of AUM, which is up by 7% this year. comprising of 191 billion in mutual fund AUM, 154 billion in PMS AUM, and 27 billion in AIF AUM. Our AMC now ranks among the top 10 players by total equity assets. Our PMS ranks number 1, while the AIF business continues to grow rapidly. Net sales is 39 billion in 9 months. Our net yield remains robust at about 0.9% for the 9-month period. Revenues at 1.4 billion in the third quarter were up by 22%, and we're at 4.4 billion for the 9-month period. Profit after tax was 345 million during the quarter, up by 8% year-on-year. For the 9-month period, the profits grew by 45% to 1.14 billion. The asset management business offers the highest scalability and operating leverage among all our businesses. Our equity mutual fund AUM of 191 billion is just 1.9% of the industry equity AUM of 9.6 trillion. Our market share in equity mutual funds, including balanced funds, stood at 2.4% during the year. Our SIP AUM is growing qualitatively and profitably. Our SIP market share in proportion to total inflows is also rising. Our share of alternate assets comprising of PMS and AIF is the highest among AMCs at 49% and continues to grow strongly. Yields and profitability of alternates is higher. As of December 18, 20% of alternate AUM is performance fee-linked, and our target is to increase this further. The private equity business manages an AUM of 60 billion, up by 30% on a year-on-year basis across 3 growth capital, PE funds, and 4 real estate funds. This business has delivered on profitability and scalability fronts. In the 9-month period, excluding the lumpy share of profits on exits, was 149 million, almost 3x on a year-on-year basis. The first growth fund, IPF1, has delivered an XIRR of 28% and alpha of 10%. Is expected to return nearly 6 times multiples of our cost. Strong performance and positioning has also aided new fundraise. We launched IBF3 in September 2017, received phenomenal response, and have garnered 23 billion rupees in IBF3. We've also launched IREF, the Real Estate Fund Series 4 in FY19 with a target size of 15 billion, and we've already achieved our first close at 5.6 billion. Wealth management business AUM grew by 7% year-on-year at 164 billion during the year. Net adds were 21 billion. The 9-month revenues were up by 21%. Profits, ESOP cost under Ind AS and intergroup transfer pricing was at 165 million, up by 12%, despite higher RM additions during this period. RM count of this business has reached 135 from 98 in the same period last year, up by 27% year-on-year. Investment in strong RM addition suppressed our reported profits. However, as the ratio of new ads to opening RMs fall and the vintage of RMs improve, both productivity and profitability of the business should rise. Yields stood at about 75 basis points during the year, led by favorable equity mix of about 62% in the total AUM. Overall, asset and wealth management revenues were at 6 billion rupees in the 9-month period, up by 4%, and contributed 30% of consolidated revenues. Profits were 1.47 billion and accounted for 50% of the total profits. Turning to the housing finance business, loan book for the housing finance business was at 44 billion. NII remains flat in the 9-month period on a YOY basis despite reduction in loan book, led by higher write-offs and lower disbursements. Margins remained stable at 4.85% in the 9-month period. This was on account of lower borrowings and higher equity increases during this period. Asset quality deterioration in 9 months was on account of seasoning of the legacy portfolio. However, proactive cleanup of the legacy book, expected positive trends in disbursements in coming quarters, along with improvement in collection efficiency from December 18, augur well for the asset quality and the profitability outlook of the business. Provisions were at 1.78 billion on account of higher write-offs in Q3 to clean up the legacy book. Provisions including write-off now stand at 69% as of December 2018. Strong support from parent continues. Capital infusion was almost 2 billion rupees during the current quarter alone, and our gearing remains quite conservative at 4.5 times. Limited repayments till March 2019, equity infusion, strong undrawn borrowing lines, calibrated pace of growth places us in a very comfortable liquidity position in Aspire. Turning to our fund-based businesses, this includes commitments to our asset management products, not only helping seed these new businesses by investing in scalable opportunities, but also present liquid resources for future opportunities. Total quoted equity investment, including unrealized gains, were at 14 billion rupees. Mark-to-market on these gains are now part of the reported earnings under Ind AS reporting. Cumulative XIRR of these investments is about 17%, which is the see-through ROE of this business in our view. To sum up, our strategy of diversified business model towards linear sources of revenues and earnings is showing results. businesses continue to make significant investments, are building scale and offer operating leverage. The portfolio of businesses are also well positioned to capitalize on the tailwinds like financialization of savings and several other macro trends. Our brand is being recognized in each of our businesses, and we remain excited about the headroom to grow in these businesses. We'd now like to open the floor for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Sahil Shah from Edelweiss AMC. Please go ahead.
Thanks for this opportunity. Just wanted to have an update on this Aspire. So almost we have spent 1 year to understand the book, and we have done at least 409 crore of kind of provisioning. So just want to have your sense that where we are in terms of recognizing the entire book, and from here on, what is your thought process on this entire?
We have been taking aggressive write-offs, as you've seen in the last 4 quarters, and to the best of our understanding, we have, upfronted, I would say, all the pain and the write-offs that were required to be done in the business, aside of the usual provisioning. So we think that going forward, we would not need any chunky write-offs of the type that you've seen in the last 4 quarters as far as this business is concerned. We have also highlighted that, the collection efficiency trends, we have seen some uptick from the month of December, and we are hopeful that the coming quarter should also be better. So without spelling out any guidance on how the numbers exactly will play out, we think that we should be closer to the peaking of these NPLs also.
Yeah, just to Sahil, just to add, this is Motilal Oswal. I think the whole version 2 of Aspire is really we are building in a very slow and steady manner. The whole focus is on getting the right kind of talent. We got a new CEO, and I think a lot of senior level people, mostly they have been hired, but a couple of vacancies are still there, which will be closed in this quarter. So the whole focus is on creating a very strong process-driven organization with the right kind of people, with the right kind of culture, and going very slow and steady, because we see the opportunity is going to be very large. We went wrong in terms of scaling up very fast. With that lesson learned, now we are going slow and steady, and we are seeing month on month now slightly numbers increasing from the sales was completely stopped because we want to understand the whole business. So now that we are gradually seeing the sales happening across 120 branches, a lot of new people have joined, the training is happening in a big way, the technology platform has been created, completely in-house technology has been done. So the whole we are going through a lot of investments to make sure that we create a very strong foundation. And to create a quality organization takes time, and we are going through that kind of, I would say, effort. We understood the problem, and most of the problem has been addressed now about people or about the quality of the book. So now I would say I remain confident about the future, but we will go very slow.
So should we take the takeaway should be taken like this lumpy, which you're saying probably 100 crore, may restrict to maybe 20-30 crore? This is the right assessment according to you, or?
No, I think what Naveen has said that there is not going to be any lumpy kind of, write-offs now. I would say most of the bigger problem which has been addressed and written off. Now, written off doesn't mean that money will not come back. Legal system in India takes time. We are seeing some sign where even the write-off, in this quarter, we have received about 7 crores worth of money which was already written off, till date, sorry. So, legal system is also geared up. We have hired about 25 legal people across the country. So, written off doesn't mean that it is written off for whole life. So, now the whole effort is to make sure that whatever amount is written off, the recovery start happening. And at the same time, we are starting slow and steady the sales engine also.
Okay. So this is about the NPA. So from here on, if everything is set, right, can we see some kind of improvement in Y1 growth in your asset itself?
I think the increment will happen, But I don't want to right now commit, but I'm very confident that now things are going to be better than what we have seen in the past. I would not like to put any number to that because how much really recovery we are able to do that. And second thing is that I also would like to put in that at least the provision covering ratio also will have to definitely increase the provision, the standard provisioning extra provision also. But I'm not seeing any big written-offs, write-offs in the future.
Okay, that's your point, sir. My second question relates to your wealth business. So, if I look at, this is my calculated number in terms of the yield. So what has happened that the yield, revenue yield is close to around 83 bips, and this quarter it is around closer to 63 bips. So is it just because of some kind of interest income which was missing for the across the board as far as the competitor and industry itself is concerned, or this is something else which has reduced the Q1Q revenue yield on 20 bips from 84 to 63 bips kind of things?
So actually in the previous quarters, we would have seen some higher yield because of the private equity and real estate funds where the yield is slightly higher. So this is a product mix which is actually playing out. So there is no impact on the yields as of now.
Okay. Thanks a lot, sir. That's all from my side.
Thank you. The next question is from the line of Ritesh Pachatia from Asian Market Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity. Sir, my question is on the wealth business. So what is the plan going ahead? Are you slowing down the RM additions and that after regulatory changes on the distribution side with respect to upfront commission and all, what will be the strategy going ahead?
So as you are aware, we have been strengthening both the legs of the distribution business. Our own retail leg of the distribution business continues to see strong cross-sell and growth. And as far as the wealth management business itself is concerned, we have basically increased the geographical footprint, which has driven this RM count increase. And as we've explained in the past, this business from a longer-term perspective, and the mandate is not really to just focus on upfront revenues, but generate a robust and sustainable scale revenue base for this business. So we are on course to that. We have a very clear positioning within this business as an equity specialist, and we see, given the change in the competitive landscape, constraints on banks, as well as, exit of many foreign wealth management houses, I think locals have a reasonably good runway over the next 5 years' time. And our own investments upfronted in this business in terms of RM addition, expanded geographical, coverage, that's in good stead over this period, in our view.
Okay. So second question is on the P business. Can you throw some light over there as it is continuously able to raise funds successfully?
In my opening address, I just mentioned to you that we had a very successful India Business Excellence Fund Series E raise of 24 billion rupees in a record time. And we are in the process of raising our next series of the real estate fund, which has already done its first close at 5.6 billion rupees. So the performance in FY19 in terms of capital raising by this business has been truly remarkable and very heartening for us.
Okay. That's all from my side, sir. Thanks a lot.
Thank you.
Yeah.
The next question is from the line of Saurabh Das. Please go ahead.
Thanks for the opportunity. My first question is regarding Aspire. So you have given the details of ECL stage 1, stage 2, and stage 3. I wanted to get the equivalent numbers for 2Q FY19 to get a trend on how these stage 3 data is performing, and what is your sense about the 40% coverage which you have for these assets? Do you think, what's the right number for that coverage as per the current trends? I have a few follow-ups as well.
Sure. So as far as the ECL numbers are concerned, Saurabh, I think Rakesh can give you both of these numbers separately in a few minutes. And as far as the coverage is concerned, Mr. Oswal has just alluded to the point that we would like the coverage ratio to further go up from the number that you spoke about, the 40% number that you spoke about, and 69% including the write-off that we've taken. So going forward, we would like this coverage ratio to further go up.
If you can just explain that typically housing assets usually would not see this kind of loss given default. So is it fair to conclude that a lot of this NPA was related to frauds where you do not have commensurate assets backing them, or?
It could be that, or it could be under construction where, really enforcing the securities or exercising the recoveries could be, a slow burn process. And the third, I would add, it could be plots, typically where the impairment could be on the higher side, unlike a, completely built residential house.
In terms of the changes to the business model, if you can allude to what are the business lines or ticket sizes or segments which you will not be doing forward, that will help us understand the extent of business realignment. So
there are, certain geographies where we have dialed down substantially, including parts of MP and Maharashtra. There are certain product segments which we have dialed down, which include plot loans and composite loans. From a ticket size perspective, we're no longer focusing on the higher ticket size, and that contributes to an negligible portion of the incremental disbursements that we are doing. This would be in the 15 to 25 lakh range. Our sweet spot is mostly 8 to 10 lakh range now. Within from a customer segment point of view, our focus would no longer be on, or would be much lesser on cash salaried versus document salaried. Although we continue to remain focused on the self-employed part of the business where yields are better. But I think aside of these, choices and the negative list that we've drawn up, as we have explained earlier, the whole organization is verticalized now. So sales is arm's length from all the 4 control functions, including credit, legal, technical, and RCU. And the collection engine is also a separate vertical. So we believe that the robustness that this architecture provides in terms of incremental underwriting is much better. We have upfronted all the costs incurred to put this structure in place, and which is reflected in the numbers. But the benefits of this will only come as we scale up our disbursements in the coming quarters.
Right. And finally, since you have realigned the business, possibly dialed down on risk and the kind of segments you chose, what's the sort of impact on incremental spreads for you in the business?
We have actually increased our rates, the threshold rate for almost 50 basis points during the last quarter. Although it does not have any meaningful impact on the overall yields because incremental disbursements have been small. But as of now, our reported yields are have been stable, in terms of the numbers that we've reported for the quarter and the 9-month period.
Yeah, so my question was on incremental spreads because, cost of fund for the system has also gone up. So are you okay to do the business at a slightly lower spread is what my point was.
There's no much impact on the spreads as of now. So our cost of funds have gone up by about 25 to 50 basis points. So and the yields have been actually improving slightly.
Great. And just finally on the asset management business on the mutual fund side, given the changes in terms of the payouts to the distribution because of the TER related issues. So how has been the initial response, and have you seen any change in the complexion of your sourcing from larger versus smaller distributors or pockets or wealth management, IFAs versus the banking channels? Any color on that?
Okay, hi, this is Ashish here. Thanks for the question. So I think, if you see in this quarter, right now, frankly, the waters are a bit muddied in the sense that is there a slowdown because of people's experience with last couple of years of investing, or is there a slowdown purely because distributors are slightly disenchanted with this business? I think that is a little difficult to decipher right now. I do believe that, if you see a lot of pricing sensitive channels, when I say pricing sensitive channels, I mean that the guys who are heavily depending on upfront commissions, so there will be few pockets in the beyond 30 cities. And there will be few pockets within the retail banking space. And as it is, there will be few guys who are, having a smaller asset base, and hence for them upfront income is more relevant than the trail book. So there are definitely certain segments which are related to retail banks, which are related to beyond 30 cities, and which are related to smaller IFAs, where I do believe that yes, there is a maybe 40-50% impact, and that is also visible in the industry's gross flows. Because if you see the net sale trend in the industry, it's not like redemptions are spiking. It's more to do with a massive decline in gross flows that one is witnessing right now. Coming to our AMC specifically, you would expect me to say that and take it with a pinch of salt, but the fact is that our dependence on beyond 30 cities has not, we are actually present physically. Our branches are mainly in the top 30 cities itself, top 28 or 29. As far as beyond 30 cities are concerned, our branch presence is practically nil, and we depend more on the national distributor network to fetch business from these cities, because otherwise we see a lot of cost duplication and channel conflict. So we don't have direct presence in beyond 30 cities, although some business comes through the national distributor network. Second point is that in the last 6 years of our existence, for our mutual funds, we never paid any upfront commission at all. So from that perspective, the channels which are very, very sensitive to upfront commissions anyway never like to work with us. So from that perspective, the impact would be muted. And the third point is that in our entire business mix, nearly half the business is to do with alternate products like PMS and AIF, and hence the overall, discussion we are having is on a very, very small part of the total business. So as far as Motilal Oswal AMC specifically is concerned, I think the impact has got more to do with the overall slowdown in gross flow in the industry and people's experiences with investing in the last year and a half. But I think on a larger industry level, if you ask me, yes, this upfront and all these things are playing their role in a big way. Also, from 1st April, the actual TAR cuts will kick in, and that will result in further reduction in commissions. All of this is going to open a larger play area for us, because we were not able to participate in certain segments in the past, and now that gets opened up for us. But I think for the industry, this is a long-term adjustment process. I think you will still see a lot of adjustments over the next 6 months continuing to happen.
Thank you, Mr. Das. We request to join back in the question queue for any follow-ups, as you have several participants waiting for their turn. We have the next question from the line of Shubham Sinha from Equirus. Please go ahead.
Yeah, hi. Thanks for giving me the opportunity. Can you give me an update on the broking business, how it is doing in this environment where there are a lot of headwinds, and which is more impacted, the retail or institution?
See, broking business, always we go hand in hand with retail, institution, even AMC flows. So everything is really right now impacted for the same reasons, because of you see all geopolitical reasons.
So the impact on the institutional equities business because of yield pressures have been greater than in the retail broking business for the 9-month period. Notwithstanding that, our own profits have grown by 32% in the 9-month period. An important contributor to that has also been our strategy to bring linearity to the whole broking business revenues and profitability by cross-selling financial products to our million retail customer base. As I mentioned, we have successfully undertaken this exercise for over 11% of our customers, and they now contribute to 16% of our retail broking revenues. And this has been an important contributor to the strong profit growth that you've seen during the current year, notwithstanding what has happened to the market volume.
Okay. And in wealth management business, which is now a very favorite in the whole sector, so now your count is at 135 RM count. Where do you expect RM at the end of, say, FY20? And how much AUM you expect to grow in FY20?
AUM is a function of the market, but we remain keep on investing into the RM. If you look at year-on-year basis, numbers are going anywhere between 30 to 35%. I think we continue to invest in not only hiring more people, but investing into their training processes and even deepening or opening more and more kind of branches. Right now, we must be there in now, 11, 12 cities? Wealth management or AMC will be in 16, wealth will be in how many cities? 10 cities, yeah. So wealth we are in 10 cities. So I think we always have been investing into wealth. We don't want really, I think, to have more and more money on table, but we want to continue to invest into the wealth business because we see huge amount of opportunities across the spectrum.
Okay, thank you very much.
Thank you. The next question is from the line of Prakash Kapadia from Anivet PMS. Please go ahead.
Yeah, thanks for taking my question. I had, two questions. On the mutual fund side, if we look at, all our schemes, M35, 30, 35, they have underperformed in the last 2 years on a SIP and as well as on a lump sum basis. So what are we, communicating and how are we tackling this to our existing and potential investors, and what has gone wrong in the performance in the QGLP? Is it paying higher price?
Yeah, good morning, this is Ramdev Agrawal.
Morning.
So, yeah, it's the toughest question to answer. But, what happened was that we launched this QGLP in 2014, and after that we started the portfolios based on those principles. It worked very well. But the outperformance was outlandish, like F35, which I have this is the largest mutual fund. This one or NTDOP. I mean, they had an outperformance, I remember, till October of 17. I mean, just 1 year. It was 17% compounded, 16% compounded for 4 years. Okay. Then in what you are seeing 2 years or 3 years of performance is actually nothing but last 1 year said bad performance. Okay. So first 4 years you did very well. You cannot have a strategy which will keep doing every year very well. You see whether it is Buffett, whether it is, you see all the masters of the past. Nobody has got every year right.
Right.
Okay. How strategy can deliver that? Because your strategy will become so God kind of a strategy that the whole industry will get turned to QGLP, which is not the case. Clearly, it's a very sound strategy. I still can't think, when things don't work, then you start thinking whether you are right or wrong. All the insights come when you don't work well. But I don't have any further insights on this. I think we are a very sound footing. And I think one of the things looking back, I'm saying, somewhere we became little more bigger trade on the oil. Somehow, silently our portfolios got aligned in terms of automotive, in terms of aviation, in terms of oil marketing companies. Somewhere the oil trade had a lot of impact in last 12 months. And last 12 months when the oil prices kind of shot up, it had its own correlations and market behavior in its own fashion, whether it is right or wrong. So I think we had, I can't correct it what has happened last 12 months, but going forward, we'll try to see that there is no one thing which is overriding on the portfolios. But broadly, I think our portfolio is same. We have not made any, strategy remains same. 1 or 2 companies will keep coming and going. And so we are able to position, like tech, we have positioned very well ahead of the curve. So those things will keep happening. But broadly, we'll keep buying quality companies, growth companies at reasonable price. But finding these companies at reasonable price has become very, very big challenge. And the economy itself doesn't have a very broad-based growth thing. So the 63 companies becoming 80 and 80 is becoming 100. So, for us to pay a reasonable price for these companies is also becoming very difficult. So there are challenges, but I think this is the right way to go, and you're there to appraise whatever happens.
Hi, this is Ashish here. So Ram has explained about our investing philosophy. I want to just share a couple of industry observations because there are very important people on the call, all active managers, opinion makers. So I want to point out a couple of things about the industry itself. In our universe, let's say Ramdev spoke about the multi-cap fund. I track a bunch of 25 multi-cap funds to appraise our portfolio managers. That's our peer set. And of course, we have Nifty 500 total return index. Now, the specific time frame of 2 years which was discussed, you'll be surprised to know that out of 25, approximately 18 funds, including us, have failed to beat the benchmark in the last 2 year time bucket. And I think that a lot of the interactions that are happening about active management are missing a simple point that if you look at exactly 2 years, the bottom of demonetization, Jan 2017, Nifty was 7,700. And August 2018 at the peak, Nifty was 11,900. So I don't think there are very many 20-month periods where the whole Nifty goes up 55 to 56%. And within this period, I think there is a big divergence between how much Nifty went up, and I think in that period, Nifty 500 has a very disjointed performance compared to Nifty itself. So I think most multi-cap funds were primed to underperform because Nifty is up and Nifty 500 has a different type of performance itself. I think from October onwards, this momentum of underperformance is broken. In fact, October onwards, we have started to outperform pretty sharply. So I think it's more to do with a very narrow index performance and very unusual bump up, like, 55, 56% in 20 months is very, very high beta. And especially people like us don't even run, our betas in all portfolios are ranging 0.7 to 0.9. I think this is something which is happening across the industry also. And of course, within that, we have to, differentiate ourselves.
Ashish, that is helpful. But, just one point to that, obviously this is a point-to-point comparison and, as Ramdevji said, you have phases of up cycle, down cycle, and no money manager in the world has consistently performed. But just, one point is, if the run-up was so fast and so large, as you mentioned, from point to point till August, when Nifty touched 11,900, and given whatever our parameters are, and the movie index which we publish on our MF website, where, getting returns from there was difficult. We could have always taken a cash call. Obviously, it's in hindsight, but, nobody stops us from taking a cash call.
No, just to correct this, we don't have cash call as a strategy. Nobody stops me from taking cash call, but in general, we are not going to take a cash call. It will be fully invested, instantly invested. That's at least one of the... that's a part of the strategy.
Sure. And one more question, our AUM in the PMS, I think 7-8% is performance linked. How do we plan to take this on the higher side? I think earlier we had mentioned we were planning to increase this particular shares. So any traction on that side of the PMS?
Yeah. So what we've done is that if you see consciously, one is obviously for operational ease, and other is to get, more, alpha or performance linked assets. One of the things which has been done consciously is that we have now, let's say, over 2,500 crores of assets, which is in the AIF business. Now, literally every rupee in the AIF is linked to performance fees. So I think in the PMS, you are right that it is about 7 to 8%. But add to that, the entire AIF book is totally in performance-linked assets. There's another trend which we have seen, and I think performance-linked assets will pick up again. One of the trends we have seen is that, when the returns are looking really, when historic returns look really great, then a lot of clients don't allow us to sign up with a performance-linked mandate. And while honestly for us it is top priority, but I think the market impact, the market behavior and our own past performance at times, results in people wanting to sign up for fixed fee. And then when the performance is down, markets are down, then again you see some people wanting to sign up with a variable fee. But long story short, our effort is that, for operational ease as well as for getting more performance-linked revenue, we would rather focus on scaling AIFs. I think that's the idea.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Sure. Just a couple of questions. In the wealth business, if I look at the quarter-on-quarter AUM growth, is it possible for you to give us a breakup between inflows and the market appreciation?
Nischint, I'll have Rakesh come back to you in a few minutes on that. I don't have that readily with me. Rakesh, are you... Yeah, sure. I revert back in a few minutes on this.
But broadly, it's a flat market, no? So I think whatever growth is there, it must be because of net flow.
Yeah, we can give you the exact...
But we can give you the net number, yeah?
Yeah, the net flow for the quarter was 5.1 billion.
Okay.
And for the last quarter it was 6.3 billion.
The net sales. Yeah.
Yes. This will help you, decipher the mark-to-market versus the net sales contribution to the AUM change.
That's right. The other thing is, on the wealth side, and this is a question where I want to really understand the strategy, going forward. If there is going to be a TER reduction and, inflows have also sort of been a little weak, then why continue to scale up the wealth business the way you've been doing it over the last couple of quarters? And in that sense, what kind of guidance or kind of impact of TER and profitability guidance if you can give us?
Yeah. So, Hello, yeah. So, basically, this wealth business, we think in this entire asset management or investment management, savings management business, two things are happening. One, the active side is getting threatened globally by the passivity. And second side, the wealth is growing all over the world, and India is going to see explosion in wealth. So, opportunity to manage wealth is massive. Now, how do you compensate the wealth manager? It's a function of, all this fight between distributor and investment advisor. That thing is on. Somewhere along the line, these things will be settled because it is not a matured industry. And even most of the clients, they don't actually allow the wealth manager to function like a wealth manager. They call the final shot, and most of the wealth managers are kind of accountant or they provide the products and introductions. So I think this business is in a very formative state, and we are not taking a short-term call in terms of profitability. Of course, the challenges what you're saying about the cut in the distribution fees for the wealth management outfit is a challenge, but it's a industry-wide challenge. And but what will be the volume expansion? I mean, what we have seen in broking is that in 30 years, broking has come down from 150 basis to 5 basis or 3 basis, and yet the brokerage industry has prospered. So I think some kind of, and this will also help us consolidate. I mean, in the exploding industry, number of players will also be lower because the break-even levels will go up. And in wealth management, it is not only break-even levels are very high, but it's also difficult to successfully build that. So I think we are optimistic about the future of this business, but short-term challenges are known to you also.
Any guidance that you can give on terms of where your yields could head for next year?
Well, just to add, Nishin, first of all, in wealth business, we have mutual fund exposure is very less. 25% of our AUM is mutual fund. Almost 15% of our revenues are coming from the mutual fund segment, where you are saying the TR reduction impact will be there. Because the bulk of our revenue and bulk of our AUM is from the alternates, where we haven't seen any regulatory action on that. In terms of yield, the product mix is changing right now. I think 62% of the mix is in favor of equity. And I think the yields will have some pressure, but not at that level, because, the kind of alternative product which we are pushing, which is in a high yielding compared to the low yielding mutual funds.
But directionally it will be lower for sure. But I don't think volume should make up for that.
Sure. And do you see a pressure building up on the alternative products as well? Because, you've seen TERs going in one segment, so people coming in and saying that, why don't you reduce your realizations in alternatives as well?
So typically in alternatives, I can imagine that, when they have spoken about upfronting and certain distribution practices related to mutual funds, then I don't think anybody of us should be surprised if they want to have a look into the distribution practices for alternates. But on the expense or on the fee itself, I don't perceive a threat really, because typically when you talk about PMSs, for instance, they are individual agreements with clients. And if you see AIF, for instance, they have already got share classes. So as the size of client goes up, the fee comes down. So I think PMS and AIF, our sense is that on the overall realization itself, we don't perceive a threat. But yes, in terms of how the distribution practices should be conducted, like they have taken a look through into mutual funds, I won't be surprised if they do it for alternates as well.
Sure. And just one last question from my side. For you and for the industry, is the direct business, this is for the mutual fund business.
Yeah.
For you and for the industry, is the direct business now more profitable? Or now with the change in regulations, the direct or the distributor channels both are equally profitable from an asset management business point of view?
One would be actually indifferent from here on. One is actually indifferent between direct and regular. There is no difference now. In fact, somebody can really argue that if I invest a lot on scaling, if I have already invested a lot on scaling direct and the regulator does not allow me to recognize any of those expenses or does not give me any credit for those expenses, then I could actually argue on the opposite hand that direct becomes expensive.
Less profitable.
Yeah, less profitable.
For sure. Less is against the direct.
Yes. So the maths, like Ramdevji is sharing, the maths is going against investing heavily into a direct practice.
Thank you. The next question is from the line of Dhruv Jain from Ambit Capital. Please go ahead.
Hello, sir. Sir, sir, we are seeing some softening in the inflow market share in our AMC AUM. So I'm seeing around a 40 bips kind of drop. Any color if you could give on that, sir?
Yeah, I think that one is, if you see, so you're talking about the mutual fund inflows. Yeah, I think that in the last 3 months, one of the things which has happened is that the play field has contracted quite dramatically. When I say play field has contracted dramatically, the inflow is in 3 parts in the industry always. One is the recurring SIP book which is there. So in that, I don't think anything changes in 1 quarter. The second is the number of NFOs. And the third is the amount of discretionary checks that people are writing every month. Now in the industry, if you see, the amount of checks that people are writing any month has dropped dramatically. That shrinks the play field for people like us. And the second thing which happens is that the amount of money as a percentage of the inflow, the amount of money collected through NFOs has kept rising. So in any given month, anywhere around 2,000, 3,000 crore of inflow is coming from NFOs. And given our product mandate is pretty sharply defined, so I don't see much for us to do by way of NFOs really. We don't believe in proliferating products. So that shrinkage, if you ask me, is because of reduction in the discretionary flows which come month on month, and that shrinks the play field in which we can participate.
Okay, sir. And, sir, one more question on the broking bit. So we are also seeing some softening around 10 bits kind of upper pitch drop in broking. Any?
Can you speak loudly, please?
Yeah.
Hello?
Yeah.
Sir, there is some shrinkage of, market share in our broking business as well. So I'm seeing the softening of around 10 bips kind of in this quarter. Anything that, can this go up from the next quarter onwards? Any color on that, sir?
Yes, actually that is on account of the mix change because we've seen mix continuously going towards the F&O. So F&O as a proportion of market now stands at 97%, which earlier was about 95% in last year. So because of the mix change, we'll definitely see the yields coming down because of the higher F&O in the market volumes.
But as we guided, the yield as well as the market share in the high yield cash business continues to remain stable.
Okay, sir. That's it from my side. Thank you.
Thank you. We take the next question from the line of Dhruvesh Sanghvi from Prospero Tree. Please go ahead.
Yeah, I just wanted to ask you related to the mutual funds business. Our focus, as I think you said, that direct is not probably now favoring in terms of the mathematics, but is our share from the IFAs or the distribution side much lower, and what is the focus out there?
So our share, actually, if you look at the industry numbers in distribution, what you will realize is that while we call it as IFA, the point is that national distributors are also primarily drawing their business through IFAs. It's basically a wholesaler versus retailer concept.
Right.
So, for example, my parent company is an aggregator. All MOFSL franchisees and IFAs empaneled with MOFSL, for example. So MOFSL acts as an aggregator for me. Similarly, there is NJ India, which is a very large aggregator. There is Prudent Corporate, which is a large aggregator. So our business is pretty much through IFAs. Only thing is that to maintain cost effectiveness and to avoid channel conflict, what we've done is that a large part of our retail business we prefer to conduct with the aggregators or national distributors. As far as IFAs themselves are concerned, we prefer to deal with the largest IFAs in every city because they do not want to get under the fold of any aggregator. They would prefer to be on their own as individual entrepreneurs. So actually, if you ask me, more than half of our mutual fund business is directly, indirectly derived from these retail channels. It's just a preference of dealing with wholesalers rather than going deep into retailers and causing channel conflict.
Right. No, so where I come from is while I was checking with a couple of new empanelments happening, it so turned out that you have stopped the new empanelments is what I came to know. Is this true? And why so? If somebody likes to empanel, you're stopping it, or is there a change in strategy, or is it a temporary thing, or?
Yeah. No, so actually there is no, I do get this kind of feedback, and I understand that there has been a bit of a discordant note out here. There is no such mindset of not empaneling. But yes, we are a little choosy and a little picky about how we want to go about empanelment, purely, like I said, to avoid channel conflict. It's not anything which is person-specific, individual or business-specific. It's very simple that if I have empaneled a lot of retailers directly, and if I have published my pricing to them, then obviously my pricing to the wholesaler gets impacted pretty straightforward, and that can have dramatic consequences on overall profitability. So we are just a bit conscious of not circumventing or sidelining the wholesaler. That's the point.
Sure. And one more follow-up on that side. Let's say today I think we should be around 17 to 20,000 crore AUM on the equity side, on the mutual funds piece. Again, this is not a guidance asking, but where can this go with a benchmarked performance? I mean, I'm trying to understand that. Let's assume that our performance does not erode, but our performance is not in the top quartile. How would then the AUM growth potentially come if the market grows at an X rate? I mean, some thoughts on that.
Yeah, so it's very difficult to build any model. But if you look at little longer shot, in the sense that as prosperity is increasing, your normal GDP is growing at about 11-12%, savings are increasing, financial savings to household savings is increasing. So I would think that equity allocation is still very low. Real estate is not any more hot, destination for redeployment. Resi yields are 2-3% all over the country. In fact, it is lower in some other parts. So I think the only good, apart from fixed income, the only allocation asset class which is left meaningful is the equities. But equity, people are fearful. So, but if you take a long shot, as the performance builds up for whatever account, like we had Modi Saab coming in, so that government, the last 4 years have been a fantastic flow. So the backdrop is fantastic for accelerated inflow. Right now, I think after 4 years, we are seeing some kind of breakdown. Again, a pendulum is swinging towards very low flow for some time. But conditions are conducive for a large flow going forward in next 5 years, I would say. So, I mean, I'm optimistic, but I would really hazard to put a number, because this is one industry which goes twice. One, because of the inflow, and second, because of mark-to-market. And, what should be the mark-to-market, what should be alpha, and what should be the inflow, net inflow? Probably at some point of time, we won't be able to take actually what is being offered by the market. So, real constraining factor is how much money we can manage, or anybody can manage. This is a problem of plenty for the responsible money managers in the years to come. That's how I look at the prospects.
Thank you. Ladies and gentlemen, due to time constraints, that would be our last question. I would like to hand the conference over to Mr. Shalibhadra Shah for closing comments. Thank you, and over to you, sir.
On behalf of Motilal Oswal Financial Services, we would like to thank every participant for attending the Q3 FY19 Concall. In case of any further queries, please do get in touch with our investor relation desk or me. Thank you and have a good day.